Hey everyone, welcome back to our channel. Today we've got an exciting video lined up for you about understanding companies and their shares, so let's dive in. In the world of finance and investing, companies play a central role as the entities that drive economic activity. These organizations range from small startups to large multinational corporations, and they offer opportunities for investors to participate in their growth and success. One of the fundamental concepts in the financial world is the division of a company into shares of stock. Together we'll explore what it means for a company to be divided into shares, how these shares work, and the implications for both the company and its investors. What is a company? A company is a legal entity that is separate from its owners and is designed to conduct business activities. Companies can range from sole proprietorships to large corporations with thousands of employees. They are established to produce goods, provide services, or engage in various business activities with the goal of generating profit. Companies are typically organized into different types based on their size, structure, and purpose. The most common types include 1. Sole proprietorship. Owned and operated by a single individual. The owner is personally responsible for all debts and obligations. 2. Partnership. Owned by two or more individuals who share profits, losses, and responsibilities. 3. Limited liability company. Combines the benefits of a corporation with the flexibility of a partnership. Owners have limited liability for the company's debts. 4. Corporation. A more complex structure where the company is a separate legal entity from its owners. Corporations can be publicly traded or privately held. The concept of shares. When a company wants to raise capital for expansion or other business activities, it can issue shares of stock. Shares represent ownership in the company and are divided into two main categories: common shares and preferred shares. 1. Common shares represent equity ownership in a company. Shareholders who own common shares have a claim on the company's profits and assets, but their claims are subordinate to those of preferred shareholders and creditors. Common shareholders typically have voting rights, which allow them to participate in decisions such as electing the board of directors and approving major corporate changes. Common shareholders may receive dividends, which are payments made from the company's profits. However, dividends on common shares are not guaranteed and can vary based on the company's financial performance. 2. Preferred shares represent a higher claim on the company's assets and earnings than common shares. They are often issued to attract investors who seek more stable returns. Preferred shareholders usually do not have voting rights. Preferred shareholders typically receive fixed dividends, which are paid before any dividends are distributed to common shareholders. If the company fails to pay dividends, preferred shareholders often have the right to accumulate unpaid dividends. How shares are issued and traded. Shares are issued and traded in the stock market, which is a marketplace where investors can buy and sell ownership stakes in publicly traded companies. The process involves several steps. 1. Initial public offering (IPO). When a private company decides to go public, it conducts an initial public offering (IPO). During an IPO, the company issues new shares to the public for the first time. This process involves regulatory filings, valuation assessments, and the setting of an offering price. The IPO provides the company with capital to fund growth initiatives and allows early investors and employees to monetize their shares. 2. Stock exchanges. After the IPO, the company's shares are listed on a stock exchange, such as the New York Stock Exchange, NYSE, or NASDAQ. Stock exchanges facilitate the buying and selling of shares by providing a platform for transactions. The price of a company's shares on the exchange is determined by supply and demand. Investors buy and sell shares based on their expectations of the company's future performance and overall market conditions. 3. Secondary market. Once listed, shares are traded in the secondary market, where investors buy and sell existing shares. The secondary market provides liquidity for investors, allowing them to buy or sell shares without affecting the company's operations. Stock prices fluctuate based on various factors, including company performance, economic conditions, and market sentiment. The role of shareholders. Shareholders are individuals or institutions that own shares of a company's stock. They play an important role in the company's governance and financial success. Common shareholders typically have the right to vote on important corporate matters, such as the election of the board of directors, mergers and acquisitions, and changes to the company's charter. Shareholders may vote in person at annual meetings or by proxy. Shareholders may benefit from dividends, which are distributions of the company's profits. Additionally, if the company performs well and its share price increases, shareholders can realize capital gains by selling their shares at a higher price than they paid. Shareholders have a stake in the company's performance and can influence its direction through their voting rights and engagement with management. Large shareholders, such as institutional investors, may have significant influence over corporate decisions. Implications of being divided into shares. Dividing a company into shares has several implications for both the company and its investors. Issuing shares allows a company to raise capital from a wide range of investors. This capital can be used for expansion, research and development, acquisitions, and other growth initiatives. By going public, a company can access a larger pool of funds than through private financing alone. Shares traded on public exchanges provide liquidity, allowing investors to buy and sell ownership stakes with relative ease. This liquidity is important for attracting investors and providing them with the flexibility to enter and exit their investments. The value of a company's shares reflects market perceptions of its financial health, growth prospects, and overall performance. Share prices can be influenced by factors such as earnings reports, economic conditions, and investor sentiment. A high share price can enhance the company's reputation and make it easier to raise additional capital. Publicly traded companies are subject to regulatory oversight and reporting requirements. They must disclose financial information, executive compensation, and other relevant details to ensure transparency and protect investors. Compliance with these regulations is essential for maintaining investor trust and confidence. The impact of share ownership on company management. The division of a company into shares can affect its management and governance structure. The board of directors is responsible for overseeing the company's management and making strategic decisions. Shareholders elect the board members, and their composition can influence the company's direction. The board's role is to represent the interests of shareholders and ensure the company's long-term success. Company management is responsible for the day-to-day operations and implementation of strategic plans. Shareholders may influence executive compensation and performance through shareholder meetings and voting. Aligning executive compensation with shareholder interests is important for motivating management and driving company performance. Effective corporate governance ensures that the company operates in a manner that is accountable, transparent, and aligned with shareholders' interests. This includes establishing policies and practices for financial reporting, ethical behavior, and risk management. The division of a company into shares is a fundamental aspect of modern finance and investing. Shares represent ownership in a company and provide investors with opportunities to participate in its growth and success. The process of issuing and trading shares allows companies to raise capital, provides liquidity for investors, and reflects market perceptions of the company's performance. Understanding how shares work and their implications for both companies and investors is essential for making informed financial decisions. Whether you are considering investing in a company or exploring the structure of publicly traded firms, knowledge of shares and equity ownership provides valuable insights into the dynamics of the financial world. By grasping these concepts, you can better appreciate the role of companies and shares in the economy and make more informed investment choices that align with your financial goals.